Hi, it's Jonathan at anycolourcar.com. I am doing today the most boring video, so I do apologise. It's boring, but it's important. So in the, I suppose you should have led the video by saying, do you want to get some free money? That's it. So I'll start again. It's a really interesting video. It's about free money. And basically, the FCA, I'm sure you'll have heard something from some area of media. The FCA announced in the last couple of weeks a redress scheme for essentially, it's a motor finance redress scheme, and it's all based around unfair commission arrangements. It covers finance agreements from 2007 and to 2024. So just to be clear, I'm not a finance expert, I'm not a compliance expert, and I'm not a legal expert. So I'm only going to tell you what I know as a car dealer, and should I say what I think I know as a car dealer, and the sort of overriding thing that I'm going to try and push throughout this video is to please don't use one of these claims companies, because they are literally taking 30% for nothing, like for zero. I mean, it is no win, no fee, but if you win, they're going to take 30%, and there's no need to, and I'll explain why. So the next stage really to discuss is which cases are going to be covered, and this is where it gets really confusing and boring and dull. So this all reverts back to something that happened in November 24, which was a court case where three mis-sold finance agreements were taken to the court at the same time and presented to the court as a sort of combined case. And the reason why I'm telling you that, and the reason why that's important, is because they cover different types of unfair agreements, and this has taken a while to unpick, because at least one of those should not have been involved, and it shouldn't have won. And if it had not been lumped with the others, it wouldn't have won. So that's created quite a lot of confusion. So the five things really that are in question, or that you might get phone calls about, there's five. So the first one, which is very easy to explain, is PCP, and mis-sold PCP. And this is easy because I can dismiss it straight away, because it's got absolutely nothing to do with this redress scheme. Are people mis-sold PCP? I would guess yeah. Have there been mis-sold PCP in the past? Yeah. If you've been mis-sold, could you win? And do you win at court? Yeah. There are court cases that go and win, and there are court cases that go and lose, but there's no redress scheme for this moment in time for mis-sold PCP. So we can put that one on the side. The next one, which I can get off the table quite easily, is undisclosed commission. So the rules, so this all changed November 24, but up to 24, the rules for us as car dealers and for any finance broker were that we should tell a customer that we receive commission, if we do, but we don't have to tell the customer how much that is unless they ask. And the reason that was decided weren't to make it difficult for customers, it was just purely that it's not an easy thing. It's not like you can put a note on your website so we receive commission, but because every finance case is different, you can't say how much that commission is. So to keep it simple, it was like, we'll tell customers we get commission. This is the FCA who decided this, not us. We'll tell customers we get commission, but you don't need to tell them how much unless they ask, and then you can tell them specific for their deal. So since November 24, we straight away immediately started telling customers how much commission we got, and so did all the compliance companies, and I guess most car dealers after that point, and I guess most finance brokers in general will have done. So they're the two types. They don't count. Neither of those count. Then we're moving on to the ones that do count, that are a little bit more grey and vague. The first one is if a finance agreement with commission was seen to be unfair, as in the commission was too high, and that had a negative effect on the customer. So the threshold for this is going to be quite high, because it's a case of, well, was the commission too high? And if so, was it a fixed commission? Yeah, but it was too high. Okay, so it's too high. Did it affect the customer adversely? So that's going to be more nuanced. It's not black and white, and the bar to qualify will be much higher. And I think it's around 39%, which is like mega high. So if the broker or the finance company dealer earned more than 39% of the balance as commission, and it had a negative effect on the customer, they're the sort of thresholds. But like 39% is a lot. I guess there might be cases where it's like a deep subprime deal and there's more risk involved. I don't know, but so that's quite nuanced. The second one, the last but of the sort of nuanced ones is where the dealer, and it's a little bit more complicated, is if the dealer has a link to the lender, and what that means is if you are set a target. So if we were to, there's two aspects. If we were to say, look, we want stock funding, so we want somebody to fund our stock for us. So let's say we want to double the size of the business. We can't afford to. We ain't got the money in the bank, so we need to go and get stock funding. So we can get stock funding off a lender, Black Horse, Close Brothers, whoever. But the quid pro quo is if you're going to have stock funding off us, we want all your finance business, but that might not be what's best for a customer. And that was one of the cases that won in November 24, was a dealer that had funding with a lender. And I think they used the words, this is the best deal we can get for you, but strictly speaking, it wasn't, because it was the best deal for them to hit their targets with their stock funder, but it weren't the best deal they had for the customer. And that works that you might, because if you've got stock funding, nothing's free. So if you've got stock funding, that money is going somewhere else. Well, it goes into them needing a certain amount of volume, and they might have the rate set at 12.9, and then another finance company who hadn't got stock funding with that dealer said, look, we can do 10.9. But the dealers said, no, we'll have to use 12.9 because I've got a deal in place with my stock funder. So that's again more nuanced, because it's got to be a stock funder account, and B, you've got to prove that there weren't a better option for the customer, because there might not have been as well. So that's more nuanced. The really black and white one is where there was something called discretionary commission. So this is the black and white one, and this is now for anybody who's bought a car or a van or a pickup on finance, or a caravan or anything, and the finance and the broker or the car dealer has had the option to change the rate for the sake of them to earn more commission. And we, unfortunately, I was trained as a salesperson. That's how we operated. This is back in 1994. And what would happen is you go and see your customer comes in. I'm interested in that car. How much will it cost me a month? We go and see our sales manager. The sales manager says it's £305 a month, and we've got it's £305 a month. And then the customer says that's a bit expensive. So go back to your sales manager. I can drop it to 295, and they're lowering the rate. And every time they lower the rate, the commission that the dealer earns drops, and that's called discretionary commission. And I strongly believe that that's a completely out of date notion. And it's fair that these claims are sort of happening. So that is the most black and white, easy to say, well, if it's discretionary commission, there will be, the chances are you're going to get some money back. Again, it has to be a threshold of, has this negatively affected the customer? But of course, if we're a car dealer and we could have done 5%, but we did 10%, then that's definitely affected the customer. So you'd expect to get some money back. The claim would then be based on the difference between what it could have been and what it was. That would be the sort of basis of it. So just to be clear, this is not all finance cases. It's absolutely and definitely not, and not everybody will qualify. So was commission paid? Sometimes, like, we still don't get commission on some deals. Was the commission paid? And if not, obviously it won't affect you. Was it a discretionary commission? Was it a fixed APR? So since anycolourcar.com's traded, we've always done a fixed APR. We've never had the option to do variable commission. Where we have more than one lender, we ensure that all those lenders are in line in terms of what rates they can charge, and where we have a variance. So if it's a higher purchase, for example, we've got 10.9 across our lenders. I mean, as this video goes out, that might change because the rates are going up because of the war in the Middle East. But at the moment, we've got 10.9 across all our lenders. So it doesn't matter to a customer whether we use Black Horse, Motonova, DSG, it doesn't matter, because they're all 10.9 and HP is HP. It's the same product. So, but as it happens, we've got pretty much same commission with all those, but it's irrelevant. However, if it's PCP, where there's a guaranteed future value, there can be a difference, because the guaranteed future value can be higher, which means the payments are lower. So in that instance, we give, and we always have operated in this way, we give the customer all the quotes. We give them on a self-service calculator. The customers can put the deposit and the mileage and the term. They can alter that, and then they can apply. So we've always given the customer the option and saying, look, you can have A, B, C, D, whichever one you want. It's up to you. You decide. On hire purchase, we don't do that, because there's no need to do that, because there's just one. But we've always had a set APR, and in that instance, there's no claim. So it's only if there's been I've done something to suit me at the expense of a customer. That is literally the redress scheme. There's another sort of exclusion, and it deals with a low commission. It's not 100% exclusion, but it's probably a high chance probability of an exclusion, and that's if the commission was below a certain amount, and it's £120 from 2007. I think at 2017 it went to £150, and those, if that's the case, they're unlikely to qualify. A lot of the non-prime deals, we get £150 or £100. So a lot of those, so they won't qualify at all. How it's going to work, so what it's not is not a fixed payout. We did think it might be at the beginning, which would be super easy. It'd reduce admin time for lenders. But what they've tried to do is make this super fair. And from what they estimated at the beginning to what it's going to be, the redress is going to be slightly less than anticipated, which you might think, well, that's not good. I'd rather get as much as possible. But don't forget, this is going to damage our economy as much as many other things. It's not the same for everybody. It's not a fixed payout. It's usually going to be based on a mix of the commission paid and the estimated financial loss. So there'll be a formula that the finance companies will work to based around that. And it's the most serious cases. What will happen when you do get your money back is you will likely get interest. And that'll be, so let's say you've bought a car 5 years ago, you had a 3-year loan on it, it's all paid, it's done. But there was discretionary commission. Is if you then are awarded a payment back, you'll likely get, usually they work on 8% annual interest. So if it's £500, you'll get probably 2 lots of 8% for the 2 years. That's likely you get interest back as well. Some people may well get nothing if they've had a low APR or competitive finance, it's not discretionary commission, or it's a low commission, etc., etc., etc. These may fall into the grounds of no commission, no compensation. The next question, this is an important one. Do you need to do anything? The answer is no. So what the FCA have set out with the idea of this redress scheme is, and the way the FCA work is that they put the expectation on you to do things in a certain way. They're not going to audit you, but if something goes wrong, if you haven't done it right, you're going to get into a lot of bother. So the FCA have done the same with this redress scheme. They're basically saying, look, finance companies, crack on, find out who's affected, contact those customers, give them the money back, we're happy. That's the job done. So the finance companies now, for them to get away for this as cost effectively as possible, they need to react quickly and get the money to the customers. And what they don't want to do, they don't want this to escalate, because the longer this goes on, every time there's a query even, it costs them money in admin. So the finance companies, to keep FCA happy and to reduce their own costs, they want to do this quickly. So in theory, you do nothing. If you've been missold because of discretionary commission, likely you'll get the money back. If you want to do something proactively, it depends how proactive you want to be. There's information. You can go on the government website, you can go on the FCA website. You can use something like ClearScore or Experian or whatever to find out your previous, if you can't remember your agreements, see your previous agreements. All the finance companies now have got pages on their website where you can send in an email or send in a completed form. So you can do all that yourself. You can wait for the finance companies, or you can use a claims company, but that is such a massive mistake, because all they're going to do is take 30% of your money. And the reason the claims companies have spent so much money in this last year on advertising, and the reason you're probably getting bombarded with cold calls about it, is because they want to do it quick. They want to get in there quick before the finance companies so that they can get 30% of your money. So if you're going to get £1,000 back from a finance company, they're going to take 300 quid. And that is honestly, it's for doing nothing. And you're going to get the money back anyway. So please don't use claim companies, please. And if you're unsure, use the resources out there. I'm pretty sure Martin Lewis's website is free, so you can go on there. They've got a lookup tool. So that, yeah, you're going to get cold calls. You're going to see adverts. Please don't put money in their pockets, because it's only going to come. The problem is these claim companies, it is no win, no fee, but the money doesn't come from the finance company, it comes from your payout. So if you're going to get £1,000, you're going to lose 300 quid if you use these claims companies. I mean, for 300 quid, it's worth having an hour on a website on a night, or even having a bit of patience. So the timings of the scheme, it rolls out, started now, it's 2026, with a view to it hopefully ending by 2027. It's going to cost a lot of money, but at least then it's concluded. So the sort of key takeaways, this is about fairness and disclosure. Not all agreements are affected, and it is a case-by-case model. And just to remember the 5 different types of claim: PCP claims, not involved, fixed APR, usually are not involved, ridiculously high commission is involved, lenders that were linked to, or dealers that were linked to a lender by a target, or you get this for free if you do this. I mean, that's another thing actually. We've got some lenders that say, look, you can have this technology if you use us. So we always say no. We just say no, we'll pay for everything ourselves, we'll stand on our own 2 feet. We want to be able to give customers the option. You do whatever you want. We've even had a lender with us, a big lender, that basically said, look, you've got a target, and if you don't hit your target, we have to put you on what they call a bucket deal. And a bucket deal just means you get less commission. It's like a generic deal, but without a commitment. Well, we always say, just put us on the generic deal. We'd rather have the lower commission, no freebies, but know that our customers, we can just be honest and transparent and give them whichever deal, you pick the deal, whichever one's best for you, as opposed to being tied in. But those agreements are counted. And then the big one is the discretionary commission. It's where a dealer can say, look, I can quote 5%, 6%, 7%, 8%, 9%, 10%, whatever. I'm going to try and get 10%, earn as much as possible. They're the deals that are definitely going to be most focused on in this, and there's a lot of them. When we were at the Car People in 2014, we switched to a fixed APR model from that point onwards, and we're allowed to do things like the APR can vary based on your credit score, it can vary based on the amount you borrow, it can vary based on the age of the car. We've got a package at anycolourcar.com for new cars, which is different to the package for used cars. That's all fine, it's fair, there's nobody complaining about that. It's discretionary commission is the ones that'll be highlighted. When Car Shop took over from the Car People, they were heavily focused on finance, and they did a sort of soft search at the beginning of the journey to determine the customer's credit worthiness, to determine what rate they got. But that was profiteering, because they actually had the same rate. So if they used Black Horse, for example, they had the same. The customer's credit score, as long as they passed with Black Horse, did not affect the APR that Car Shop got in effect. So what they did is they would say, well, you were a 662, you're 16.9, or if you're 882 score, you get 6.9. But in theory, they could have done everybody at 6.9. But they just earned more commission by doing the 16.9s, which is so that's the type of thing that is frowned upon, and I think personally, rightly so. I think that there's been enough. This industry that I'm in, as I've seen it go from literally the Wild West in 1994 to much more regulated now, with Consumer Rights Act and Consumer Duty, with the FCA, and then they've elevated to Consumer Duty, which has gone from treating customers fairly to good customer outcomes, fair to good. And then we've had the Consumer Rights Act in 2015. So it's getting harder work for us as dealers, because not everybody plays with a straight, not everybody plays the game straight, and unfortunately some customers use this to their advantage. It's a known thing. Customers do some really horrible things. They buy a car, strip parts off it, reject it under the Consumer Rights Act. The dealer's left with a car with a £1,000 catalytic converter missing. So for us, the regulation makes the job more difficult. But when you take the sort of higher view of it, it's right. The things that happen are right, and this redress scheme is right. It affected us. We couldn't offer finance for 2 weeks in November 24. So yeah, of course it affected business. It'll affect the finance companies, which in turn will affect probably our ability to do better deals. I mean, I guess, essentially the rates will go up as a result of this somehow. But I think it's right, and it draws a line under it. So, key takeaway, please don't use a claims company. I promise this is the most boring video, and we will try and do more interesting videos. But it's a really important thing. I think it needed to be mentioned. And all I can ask is that if you do get a payout, please come and spend it with us and buy another car. But that's a joke. But in seriousness, please don't use a claims company either way, or use the resources that are free. There's plenty of them.